In Chapter 5, we're dealing with the operating cycle. Our goals or learning objectives for Chapter 5 are as follows. We're going to identify the management issues associated with a merchandising operation. There's several different management issues that, as a manager of a merchandising operation, you have to be attuned to. Okay, we're going to talk about the terms of sale relating to merchandising transactions. We're going to talk about preparing an income statement and recording merchandise inventory and cost of goods sold under both what we call a perpetual inventory system and a periodic inventory system. And we're going to describe the internal control components for a merchandising operation and some of the limitations of those internal controls. Okay, so starting out with objective 1, those management issues. Okay, so first of all, service business is a little bit different. We're dealing with what we call intangible items. Okay, with a service business, we're providing just a service. So maybe a haircut. Maybe you go into the doctor's. The doctor provides GES Landscaping provides a service. That's correct. So all those types of businesses provide a service. However, a merchandising business, they provide products. They provide tangible items to customers for them to buy. As such, a merchandising business has a big responsibility, a large responsibility associated with managing their merchandise, managing the inventory. They have to manage the operating cycle that goes along with the buying and selling process. So there are 5 primary issues that they have to address in their merchandising business. They have to evaluate their liquidity, manage the operating cycle, choose an inventory system, manage foreign business transactions, and then address and manage internal controls. So we're going to look at each one of these individually. And first up is evaluating liquidity. So in the evaluation of liquidity, we want to make sure that our business has enough money on hand to pay their bills when their bills are due. They also need to be able to address any unexpected events that might arise. The primary ways that they go about managing this liquidity and evaluating it is they use the working capital and the current ratio and the quick ratio, all of which we learned about in Chapter 13, okay? So they evaluate these ratios to help them decide how well they're doing in terms of their liquidity. You know, how able they are to be able to pay off their bills, their short-term bills in the current period. Okay, and as we saw last chapter, we're going to evaluate both working capital and the current ratio. And the working capital formula is just our current assets minus our current liabilities. We obviously want it to be greater than, we want our current assets to be greater than our current liabilities. We do not want to have a negative number here, okay? And then with regard to our current ratio, we want our current ratio, our current assets over our current liabilities to be greater than 1 to 1. Then, in terms of looking at and managing the operating cycle, managing the operating cycle is all about the cash flow management. Okay, it's all about a business being able to evaluate their merchandise inventory and look at, a series of transactions. And that series of transactions starts with the buying of goods, okay? And they're going to either buy their goods for cash or credit. Credit would be on account, and then they have to be able to pay for those goods, sell those goods, and collect on any sales for things that they sold on account. So make sure they're collecting their accounts receivable. That combination of things is called the operating cycle. And businesses have what we call a financing period. And the financing period is the time between when items are paid and the end of the operating cycle. Okay, so again, this all relates to cash flow management and liquidity. Remember that liquidity is one of our two primary goals for every business. Profitability and liquidity are two primary goals, okay? So look, this is a really key portion of a merchandising business. So merchandise inventory is just the goods that are on hand from a definitional standpoint. It's just the goods that are on hand for a business to sell to their customers. So in terms of managing cash flow, they have to plan for the receipts and the payments of their cash. God bless you. And so the operating cycle, pardon me, the formula becomes the average days of inventory on hand, which again, remember we learned that formula last chapter. The average days of inventory on hand plus the average days to collect accounts receivable equals your operating cycle. For some businesses, this operating, God bless you, this operating cycle can be longer than 120 days. It depends so much, though, on the business. Okay, some businesses are going to be quite a bit shorter, so it really does depend on the business and the industry. Okay, so if you look at this little graphic, it kind of helps to explain how the operating cycle works. Okay. The top bar there being, the whole operating cycle period. This is when the inventory is purchased, and it may create a payable for us. This is when we're paying our, this is when we're paying for our inventory that we purchased. This is the period of time that it takes to turn over or pay our, turnover or sell our accounts, our inventory. This is the receivable that's created as a result of selling that inventory. And then this difference is the financing period. Okay? It's the difference between when we purchase our item and when we pay for our item, which may be before we actually collect our cash. So a lot of businesses during that financing period, they use what we call a short-term line of credit that helps to manage them through that cycle, okay? It helps them to be able to meet their needs for cash before they collect their receivables. So a lot of times on your company's financial statements, like if you go into the footnotes and you look at what that short-term debt is, you might see in there something that says short-term line of credit or line of credit or inventory line, something like that, and that's really relating to this whole operating cycle. Okay, let's see, did the page disappear? Okay, so businesses have to choose. Our third management issue is that businesses have to choose an inventory system in terms of helping them to manage how they're accounting for their inventory. The two primary types of inventory systems are perpetual, meaning that the business continuously updates its purchases and its sales of their goods. So it's ongoing. The cost of each item is recorded directly, in this case, into merchandise inventory. This perpetual inventory system is really greatly enhanced by computers, okay? Back in the day, it was much, much more difficult to manage your inventory on a perpetual basis, especially for a very large company, because it was very hard to know exactly what you had every moment of time because you weren't constantly able, you had to manually update your inventory. Well, now with computers, you can do it on an automated basis, and so it makes the process of being managing a perpetual inventory much better, much more feasible. So as items are sold, its cost is transferred from merchandise inventory to cost of goods sold. So think about it this way. When I buy, let's say I'm buying these coffee mugs to sell, okay? If I'm buying them to sell, when I buy them, they go onto my balance sheet as an asset, right? Because I've bought it, okay? I haven't done anything with it yet, I've just bought it. When Maggie comes along and she buys this asset from me, now I've got to take that asset out of my inventory and transfer its value to my cost of goods sold. Okay, sort of like we do when we do the updating of supplies and we transfer it from supplies into supplies expense. Does everybody remember kind of that process, right? Okay, when we get it out of supplies and we're trying to match that value of what we've used up with our income, same process with our cost of goods sold. We had this asset, now we've used it up in the sales process. It's no longer on our balance sheet, right? Once we sell it, it's no longer on our balance sheet. Well, it doesn't disappear and go away. We have to transfer it over into our cost of goods sold. So that's how we get that whole cost of goods sold, okay? So, and we'll learn about all the types of entries that go along with this over this chapter and the next chapter, chapter 6. Okay? And obviously computers have enabled most of us to do the perpetual inventory. And then the second form of inventory system is the periodic inventory system. And with the periodic inventory system, the primary difference is that we're updating the inventory balances at the beginning and the end of the accounting period. And that's it. So technically speaking, our cost of goods sold and our inventory values are a little bit off every day until we do those updates at the end of the accounting period. Okay? So there's a little lag there. And typically speaking, this is used for high volume, low cost merchandise. So it used to be like, say, a dollar store would never operate under a perpetual inventory system because it was so hard to. They had so many little itty bitty tiny things that they were selling, and they're such low value that it didn't really matter per se to update it on a daily basis. Like, remember we talked about cost benefit? Okay, the cost benefit really wasn't there. But now, a lot of this does go away, even in a high volume operation like, you know, a dollar store, because of computers. Okay, and this, with regard to periodic, is extremely important. The physical count is usually taken at the end of each accounting period. Now, in both a perpetual and a periodic, they both do an actual physical inventory. Okay, but it's much more crucial in a periodic because it's your only way of truly knowing your values. Okay, fourth management issues, foreign business transactions. This has to do with us selling merchandise overseas and expanding our sales capacity by doing that, as well as when we purchase things from overseas. So from a business standpoint, clearly it provides a lot of opportunity to buy products that we wouldn't have otherwise, and also from a sales standpoint it does as well. The problem comes in terms of dealing with foreign currency adjustments, okay? Because there are differences every single day between the value of our dollar and whatever currency we're using for the sale. And there's a timing difference. So every foreign transaction, you're going to say in that transaction, in that contract, you're going to say, are we dealing in dollars or are we dealing in yen, okay? And because there's those valuation differences, okay? And so a lot of you may see that. You might see foreign currency adjustment on your financial statements, and that really has to do with this issue, okay? And obviously it provides a chance for gains or losses depending upon how the adjustment works. So is it a positive from our dollar standpoint or is it a negative from our dollar standpoint? Okay, and then lastly, we have the internal control of merchandise operations. Okay. Moving into Objective 2. In Objective 2, we're going to discuss the terms of sale relating to merchandising transactions. I'm going to put this whole slide up here. I'm not sure why it comes in oddly, but it does. Okay. So, actually, okay. So first thing, in terms of trade, terms of sale, we have two different ways to look at terms of sale. First is to look at what we call trade discounts. Trade discounts are what we call a reduction from the list price or the catalog price for merchandise, and a trade discount is not recorded in the company's financial statements. So for instance, if you were to go about the process, let's say I had a catalog. If I was a buyer for Target and I'm buying, I don't know, maybe I'm buying tissues from Puffs, whoever makes Puffs, okay? These guys, Puffs, are going to have a list price for, a box of tissues. Maybe that list price is, $10, okay? They have this list price of $10, but because maybe I'm a high volume buyer and I'm going to buy a lot of them, they'll let me buy it for less than the list price, okay? That list discount item, so maybe they'll let me buy it for, $4 a box, okay? That list price item, that list price versus what I buy it at, I don't record that difference. That's just the contractual difference, okay? I record for my price, I record it at $4, okay? Now, that's different, okay, than what we call a sales discount. Sales discounts are a discount for paying early. So, once I've negotiated with Puffs to buy my box of tissues at $4 a box, now Puffs may give me even more incentive to pay them quickly. Because remember, they've got to manage their cash flow too. Okay? So they're going to give me incentive to pay my payable to them more quickly. And that's what we call a sales discount. And that sales discount is going to be printed on the invoice. And that sales discount is recorded by both the buyer and the seller. Okay? As a buyer, I record it, relating to my payables. And as a seller, I relate it to my receivables. Does that make sense? Because as a buyer, I'm buying and I owe them money. So it relates to my payables. Okay? And the way that the terms are always expressed, they're expressed something like this. 210 net 30. Okay? So what that 210 net 30 means, I'm going to go into on the next day. But purchase discounts, I'm going to on the next page because I know I have a next slide that explains it. Okay? So 210, 2% on the discount. The discount is 2% if the discounted payment is made within 10 days. Otherwise, the full payment is made within 90 days. Okay? And then purchase discounts are from the buyer's standpoint. Okay, I'm going to try to go over here. So this is important. So the discount percent is always the first number. The discount period is the second number. And then the total period to pay it off is the last piece of information. Okay? So if I pay within 15 days, I can get a 3% discount. Yes?
How many objectives do we do?
Yeah, why? Sorry. Okay, so the amount of the discount is determined by the credit terms indicated on the invoice. And it's going to be expressed like this. Okay. In addition, now, as a merchandising operation, we also have to deal with what we call transportation costs. And you need to know who's paying the transportation costs. So like as the buyer, am I paying the transportation costs or is the seller paying the transportation costs? And the way that we determine that is by the term FOB, which means free on board FOB shipping point means the buyer bears the shipping costs and title passes at the shipping point. We talked a little bit about this in, what was it, chapter 4, I think? We talked a little bit about where title passes and who owns it, okay? So if the buyer is bearing the shipping cost, then title is passing at the point of shipment. The reason that is because the buyer owns it. So if the buyer owns it at the point of shipment, then it makes sense that they're going to be paying the shipping cost, which differs than FOB destination point. This means the seller is bearing the shipping cost and title passes at the delivery point. Okay, and that chart, just a little bit further explanation there. So, looking at terms of sale. Look at a couple of examples. So if we have an original sale on credit with terms of 210 net 60. Okay, so clearly we've sold something for $300 and somebody owes us $300. We sold it on credit. If they pay within 10 days, how much of a discount are they getting?
5%.
No, 2%. 2%. 2%. 210 net 60. It's all right. 2%. So it would be 2% off of the 300. So if the customer takes advantage of that discount, this is how we would record this transaction when they paid the account off. Okay? We can't record it all into cash because we're not getting all of the cash, right? We're getting only $294 of the $300. We've got to wipe the whole account receivable off of the books because it's gone. They don't owe us $300 anymore, okay? So the way that we reflect it is we reflect it as that sales discount, okay? So we debit cash, and then we debit the sales discount, and we credit the account receivable. Do they have to take the sales discount? No. Okay? If they don't take the sales discount, we would record our normal situation where we get the $300 and the account receivable will go away. Yeah.
Wait, so is 60 the amount of days they have to pay
Correct.
for it? And
Correct.
what if they don't pay for it?
Okay. So if they don't pay for it, which sometimes does happen, very good question. Sometimes they don't pay for it. And it depends on how their contracts are written. Okay? A lot of times what will happen is there's no penalty for a period of time. And sometimes beyond, probably not 60, right after 60 days, but maybe beyond 90 or maybe beyond 120 days, then the seller might start charging them for it, okay? So a penalty, okay? But that's where, like every company has an account receivable collections person. That's where somebody's getting on the phone and going, yo, you owe us $300. You need to send us a check or wire us the money, okay? Because otherwise that negatively impacts their operating cycle and their financing period. It lengthens their financing period, and now it's costing that company more money. Because if they had to borrow on their line of credit, they're paying interest on that line of credit. And so it costs some money. So it really is a bad thing if they're not. And you'll see that. If you look at when the company's accounts receivable period gets longer, that's an issue for a company. Yeah, Sam.
What's the on sales discount? That's just how much you're taking off the price.
Yeah. So literally, if you take $300 and you multiply it by 2%, the discount is the $6. Right, exactly. I'm sorry. Yeah, so the discount is it's just taking the 2%, multiplying it by the account receivable, and that's how much the discount is. Good question, Sam. I'm sorry. Okay? Does that make sense? Does that make sense? Hi, Nate. Okay. Okay. Sorry. Thanks. Thanks, Nate. All right. So now, if we have an original purchase on credit with terms of 210 net 30, now we're the other side of the equation here. Okay, so this is the other side. We're the purchaser. Okay, when we purchase inventory, We either put it into purchases or merchandise inventory. That should be indented over. That $1,500 should be over a little bit. I'm sorry. As a debit, and then the accounts payable is the credit. Okay. So now, what is the discount percentage on this? The discount amount on this one? If we took the $1,500 and we multiplied it by 2%, what's the discount? 30, right? Okay. So if the discount's taken again within the 10 days, this is how it looks from the buyer's side of the equation. So this is important because this might be a really good test question for you guys to know, okay? So the accounts payable is going to go away, right? You're no longer going to owe that, but are you paying out a full $1,500?
No.
No, you're not. You're only paying out less the discount. So you're only paying out $1,470, but you have to reflect, otherwise your debits and your credits wouldn't equal. So you have to reflect that as a purchase discount, okay? And then that's the other $30. If you didn't take the discount, if you didn't take the discount, it would look regular, it would look like how all the transactions are that we've done all year. We would debit our accounts payable for $1,500 to get it off the books, and we would credit our cash. Okay. Last piece, I believe, for this section, okay, is credit card sales. So, businesses clearly like to do credit card sales. Why do they do credit card sales? Why? Especially in this day and age. It's
time to make that.
okay. What's that?
I don't know. Okay, she said my answer was wrong.
Okay. Why? It's all in the computer. That's true. Sean, you said something else too. It's more convenient for who?
The buyer.
The buyer, right. How many people like to walk around with lots of cash in their pocket? You do? No, I hate it. Never carry cash. Hate carrying cash. Okay? So it's more convenient. Two, if you're at a store and you only have $100 and something costs $107, are you going to be able to buy it? No, you can't. So it facilitates and increases sales for companies. Okay, but do you guys realize that for every transaction that a company does with a credit card, it costs that company money?
Yes.
Okay, right. Well, some businesses do. Some businesses do. They try to mark it up. They mark it up to try to offset the cost. Okay. And some companies set a minimum purchase amount. Good. So another reason that businesses use credit cards is because it decreases some of their risk. Okay. So if they were to establish lines with you, like let's say Robinson's hardware store, somebody. Let's say somebody has a landscaping business, okay, and they buy a lot of stuff from Robinson's hardware store. Well, back in the day, Robinson's hardware store would set up lines of credit with all these little businesses so that you wouldn't per se have to go in and pay cash every time you bought something. But at the end of the month, you might have to pay up your bill, right? So nowadays, many companies just use credit cards because what it does is it shifts that risk of collection over to the credit card company. So now, as Robinson's hardware store, I don't have to worry about having some guy in the back office calling up Sean and saying, Sean, you owe me for those rakes that you bought last month, okay? Pay me my bill, okay? They allow the credit card company to do that. Yes, Rachel.
So if you go to the store and buy something with a credit card, whether it's if it's just a normal credit card or a credit card from there, they still get the money regardless if you pay the credit back or not, right?
Absolutely. Correct. That's exactly right. That's the whole shifting of risk to the credit card company. That's why people with higher risk that have lower, that have worse credit ratios and credit reports and stuff, that's why their interest rates are higher because they're more of a risk to the credit card company.
Oh, okay.
Yeah. Okay. But it doesn't matter to me. If I'm Macy's and you don't pay your credit card to Visa, I don't care. I'm done. I'm out of it.
Okay.
You know, that's why they'll turn off your credit card too. Okay, they put limits on it, etc. Okay. So partially offset by the cost of credit card transactions. So the benefits are a little bit offset by the cost. So credit card issuers generally charge a fee to those businesses somewhere between 2 and 5% of every transaction. Okay, 2 and 6%. The discount is considered a selling expense for the company. So it's considered part of their sales expenses. And we'll do the calculations in a minute. So if we have a company and they sold $1,000 in credit card sales for the day, and then Visa charged them a 4% fee, this transaction is going to look just like this. They're going to get their money from Visa pretty much that day. Okay, Visa's going to put the money into their account. Okay, but Visa's not going to give them a full $1,000 for all of those transactions. Visa's going to take their fees off the top. Okay, and so it's going to be considered a credit card, what we call discount expense. So Visa keeps their 4% fee of $40, so they only send my company $960. Follow me? I don't have to go and send them money, but I don't get the full $1,000. So this is how we would record this transaction. Okay, so let's do some problems here. You know, and if we're really lucky and we do this fast, we'll go to the computer lab and you guys can start on your homework.